Welcome to The Explainer. We've got a truly massive topic to unpack today. We're looking straight at the 2026 AI landscape, and we're going to map out exactly how this industry is shifting from this period of just unbridled, crazy infrastructure spending into a much harsher era, an era of strict revenue reality and honestly inevitable regulatory friction. So if you want to understand where the absolute smartest money and the most powerful tech are flowing this year, you are definitely in the right place. Let's get into it.
Right off the bat, let's dive into the core tension here. 2026 is already being dubbed the year of proof across Wall Street and Silicon Valley. The days of rewarding companies simply because they bought up every GPU in sight and announced a shiny new data center, yeah, that's completely over. The market is now demanding absolute, rock-solid proof that these colossal investments are actually translating into sustainable business profit.
And to really wrap your head around the pressure these companies are feeling right now, you just have to look at this staggering number. $500 billion. Let that sink in for a second. That represents the collective AI capital expenditure planned by just the top hyperscalers this year alone. I mean, we are talking about a scale of spending that is practically unprecedented in modern tech history.
When you break down exactly where that capital is going, Microsoft is leading the charge with expected CapEx north of $150 billion, mostly for Azure and Copilots. But look closely at Meta. They've engineered arguably the most aggressive infrastructure expansion of the whole group, jumping to an estimated $135 billion just to fuel their Llama models. Amazon is right up there at $125 billion, pouring cash into custom Trainium chips. And Alphabet is committing over $90 billion for their TPUs and Gemini models. The sheer velocity of this cash deployment is just wild.
Now, all this spending leads us right to a major headline that definitely turned some heads recently. Alphabet announced a historic $80 billion equity raise to help fund this exact AI infrastructure build-out. When you realize that this is Alphabet's first major equity issuance since their IPO back in 2004, it's pretty natural to ask, wait, should investors be hitting the panic button over stock dilution?
Well, to answer that, we have to look past the flashy headline and dig into the actual structure of the deal. That $80 billion is split into three buckets. You've got a $30 billion underwritten offering, a $40 billion at-the-market program, and, this is the critical part, a $10 billion private placement directly to Berkshire Hathaway. Getting that Berkshire cocking, that is a huge vote of confidence from a notoriously value-focused investor. Plus, remember that Alphabet bought back $62 billion of its own stock in 2025 alone. So sure, new shares dilute the pool, but their ongoing buyback machine is actively offsetting a huge chunk of that pressure.
And it's not just the public giants either. This enormous scale of investment is totally bleeding into the private side of the AI race. Anthropic just confidentially filed for US IPO, and get this, they're targeting a valuation that approaches a staggering $1 trillion. A trillion! This is clearly a strategic, aggressive move designed to beat their main rival, OpenAI, to the public market and essentially set the ultimate benchmark for how public investors value generative AI.
So how on earth do you justify a near trillion-dollar price tag? Well, just look at the underlying metrics driving their prospectus. Anthropic has actually hit a $47 billion revenue run rate. And to support that kind of explosive growth, they just signed a massive landmark deal with SpaceX. They're committing to pay $1.25 billion per month, every single month through 2029, to use the Colossus One data center down in Memphis. It perfectly highlights how inextricably linked the AI race is to physical, heavy-duty infrastructure and just vast energy requirements.
Part 1. The reality. The era of agentic AI. Okay, to figure out how these companies are actually going to generate revenue from all this, we got to look away from the data centers and back to your everyday desktop. We are entering an $8.5 billion market trend that is fundamentally rewiring how business is done. I'm talking about agentic AI. We're moving past systems that just generate a cute poem or summarize a long email. These new systems can autonomously perceive their environment, execute complex, multi-step plans, and literally take physical actions across different software tools on your behalf.
The easiest way to grasp this leap is by contrasting it with what we've all been using for the last couple of years. Chatbots, right? They answer questions conversationally, but they require constant human prompting and hand-holding. Agentic systems, on the other hand, are given a goal and they just autonomously figure out how to achieve it. This jump in capability is exactly why enterprise investors are practically demanding that we move past simple chat interfaces and get into deep operational automation.
And we're actually seeing this play out live right now in tools you probably use every day. Look at Google Workspace. They're rolling out these agentic skills that allow teams to automate really heavy administrative burdens, like invoice reviews. Think about it.
Instead of a human opening an attachment, digging up an old email to compare it to, and manually checking for billing errors, the AI agent does all three of those steps securely and entirely on its own. That is tangible, measurable ROI that businesses are willing to pay for.
And that utility is spreading like wildfire across the whole ecosystem. Workspace is now letting users build interactive mini-apps directly on top of their data right inside Sheets. Google Vids is generating custom avatars in 24 different languages to completely eliminate studio production costs. Gemini is doing multi-step auto-browsing in Chrome for you. And their automated note-taking? That's expanding beyond just Google Meet to work seamlessly across Zoom and Teams as well. It's all about deep, native integration into the core daily workflows of hundreds of millions of people.
Part 2. The friction, regulation, and rights.
Because let's be real, you simply cannot deploy trillion-dollar world-altering tech without ruffling a lot of feathers. Let's start with content rights. The UK's Competition and Markets Authority, the CMA, has actively stepped in to protect media websites. Publishers have been complaining loudly that Google's AI summaries, the ones sitting right at the top of search results, are just decimating their click-through traffic and ad revenue. Sarah Cardell, the CMA chief executive, recently made it very clear, stating that it's absolutely crucial for news organizations to have actual bargaining power over how their content gets used.
And this pressure has led to a massive, world-first shift in the rules. Under the old system, if a publisher tried to block Google from scraping their content for those AI summaries, they risked completely disappearing from traditional Google search results, which is obviously a total death sentence for website traffic. Well, the new CMA rules force Google to decouple those two things. Now, UK publishers can explicitly block their content from showing up in AI summaries, but still keep their normal ranking in traditional search. It's a huge shift in power dynamics.
Meanwhile, over in the United States, the friction isn't just about copyright, it is squarely focused on cybersecurity and national defense. There's a recent executive order signed by President Trump that mandates new oversight for advanced AI. Under this new order, companies have to notify the government before they release what are being called covered frontier models. This immediately triggers a 30-day Treasury-led cybersecurity review. The goal is to make absolutely sure the model can't be exploited by adversaries to autonomously hack critical infrastructure before it's even allowed to be released to trusted partners.
But honestly, regulating the space is just incredibly messy, and this next fact perfectly captures that tension. Right now, the Pentagon is actively relying on Anthropic's Claude model running inside the Palantir Maven system to drastically speed up military targeting cycles. Yet, literally just months ago, the Department of Defense labeled Anthropic a supply chain risk because the company refused to drop its restrictions on mass surveillance and autonomous weapons, so you have the government struggling to regulate the exact same frontier AI companies that it now critically relies on for a military edge. It's fascinating.
Part 3. 2026, the year of proof.
So, bring it all together. Between the $500 billion server bets, the rise of autonomous agents, and the regulatory walls closing in all around them, what actually separates the winners from the losers this year? Well, the winners won't just be the ones hoarding the most compute power. They're going to be the companies that can prove revenue realization, showing that AI is finally improving their gross margins, not just blowing up their capex. They'll need inference optimization, using custom silicon to crush the operational costs of running these massive models. They have to have regulatory defensibility, meaning proactive compliance with massive frameworks like the EU AI Act. And finally, agentic maturity. They have to move past disconnected little chatbot pilots and deliver deep, structural automation for businesses.
It is an insanely high-stakes balancing act. The technology is just advancing so much faster than our electrical grids and our legal systems can possibly handle. So I want to leave you with this to ponder. As the costs keep skyrocketing and the friction intensifies, who do you think will successfully navigate the energy limits, the data constraints, and the regulatory bottlenecks to truly win the 2026 AI race? Keep your eyes closely on these metrics, guys, because this landscape is literally shifting daily. Thanks for tuning into this explainer, and keep learning.